Hello, and welcome to the Logistics Management Podcast Series. My name is Jeff Berman. I'm Group News Editor for Logistics Management Magazine, as well as the Peerless Media Supply Chain Group. Today is once again a real pleasure to welcome back Tony Hatch to our podcast. Tony is a longtime friend of Logistics Management Magazine and serves as the principal of ABH Consulting based in New York City. Tony has more than 3 decades of experience in the freight railroad and transportation sectors, primarily as an analyst. In his role at ABH Consulting, he's focused on the freight transportation segment, particularly surface transportation, and is well known for his knowledge of the intermodal sector where various modes of freight transport converge. Uh, and Tony has also been a key keynote speaker at several dozen industry conferences. Prior to launching ABH Consulting, he was an analyst at a few different firms, including Salomon Brothers, Argus, Payne Weber, and NatWest Markets USA, prior to rolling out ABH Consulting in 1999. Lastly, he also programs the annual and also excellent Rail Trends Conference, which is held annually every November in New York, features C-level speakers from Class 1 railroads, short lines, and various industry analysts and experts. Tony graduated from Harvard, and now they were almost in October. I should add, he's also a huge supporter of the LA Dodgers, defending World Series champions. So we'll be talking playoffs when this call wraps up.
Yeah,
Tony, welcome back.
thank you. Yeah, I'm not sure when everybody will listen to this, but yesterday the Dodgers won the Western Division title for the 12th time in the last 13 years,
I saw
um,
that.
and which is really good. Although I will say we're about 25 games below where analysts have put us in terms of wins. So this is not the year we thought we'd have with all the talent. We have about $50 million invested this year in the worst relief corps in the history of the game.
Oh God. Well, I'm gonna have to do some digging into that after the call for sure. I
Absolutely.
I was not aware of that. So Tony, why don't we start sort of at the top as we have done in the past? And that's just sort of a look at sort of the state of market conditions, I guess year to date, if you will. I'm talking like volumes, service levels. How are you sort of viewing and assessing things at this point?
So are we talking carload, intermodal, or both?
Both, please.
The volumes are tricky. You have, and they really haven't. We haven't had like a base year since the high teens, and that's unfortunate. It's really much easier for us analysts to say, "All right, this was kind of a slow growth, economy. No, nothing really happened." From here, what can your actions as a management, your capital expenditures, your application of technology, what can they do? And we've always had something, right? We had a pandemic. We had East Palestine. We had labor disruptions
Yep.
on railroads and at ports and at customers. We've had two terms of trade wars, and this one being much worse. Now we have a merger. There's always something. I don't know if that's the way of the world. Certainly, weather disruptions are more frequent, but basically, you're asking. I would say, the rail volumes reflect a slow growth economy, um and the numbers appear to be more all over the place than that, because if you have, for example, Canadians coming off easy comparisons because of wild labor disruptions both at ports and at the carriers last year. So you have the trade issue of pre-buying, and we won't have much of a peak season, if any at all, because a lot of that was shifted as the tariffs have been put on, taken off, had a moratorium, been threatened, all sorts of things, creating a general economic sense of uncertainty that is sort of reflected in rail volumes. The biggest issue, you've had a little bit of recovery in coal, but we know that that's a dead cat bounce. And I
Hmm.
apologize to my two cats, who luckily are not in the room. And that is, part of a sign of electrical demand. We've had industrial products be okay. Domestic intermodal is up, but only slightly, and that's a sign. Domestic intermodal was really strong last year, and there was a real sense of momentum. And I wrote about it in my Big IANA white paper, that I thought market share recovery was possible, but it is sort of reversed a little bit this year. And part of that is we've had a freight recession, reflecting in too much truck capacity really since fourth quarter of 2022. International volumes are coming off, because of the global political situation. So when you're looking at all this, railroads in the second quarter, and I think again in the third quarter, will report okay numbers. They've basically had to walk back some of their earlier projections for a second half
Hmm.
stronger economy. The earnings, however, will be very solid. They know they have learned how to handle range bound, volumes and produce pretty good earnings, pretty good cash flows. But nobody will really care because everybody's going to be talking about this merger, whether it'll happen or not. But from
Yeah.
the underlying economy, not great tea leaves to the future. Railroads did not ever take away their earnings guidance, unlike other industries, the auto industries and others. When all this stuff happened, the tariffs and trade wars and political machinations, they kept them, but they're really, very vague. And their outlook is pretty vague. And that's because everybody's outlook is pretty vague.
Yeah. Yeah, no question about it. It's interesting. I had looked at my notes, and when we had last had you on in the spring in April, when we were talking about service, you said that service at the time was solid, albeit rail networks were not being highly stressed, as at that point, carload volumes year to date were up something around like half a percent, 0.5%. Based on the AAR's most recent data, U.S. rail carloads are now up 2.2% year to date through the week ending September 20th. Uh, Getting back to what you said at the time, you said the real test will come when we do get a recovery, a meaningful recovery in volume in terms of what may happen to service levels. I mean, short of having a crystal ball, how do you think? I'm not asking when volumes will return, but what would be the customary process, or what would be the after effect on service when volumes bounce back? Using,
So
I guess,
I'm
yeah, go
really
ahead.
glad you asked about service because I didn't address it in the first thing. First of all, the increase from kind of very flat to plus 2.2, a lot of it reflects coal, which was down hugely last year and is now, up, especially in the Western US. So that sort of smoke and mirrors a little bit of this volume.
Hmm.
It's growing low single digits in real terms if you could smooth out comparisons, and that's not terrible. And that's sort of what the economy's doing. Service has gotten better, if anything, since we last spoke. And rail services generally acknowledged. It's acknowledged by the regulator to be, as good as it's ever been. And I'm not. It's certainly close to that. That's of course not quite good enough. Meaning that the like a dog chasing a car, you'll never really catch it
Sure.
because every time your service gets better, so will customers' demands for service. That's the cycle you want to be in, is trying to catch a car that's accelerating. Right now, the car isn't accelerating. Rail service is really good. The question everybody has is when volumes truly take off, not just comparison numbers, right? And when we're looking at the deltas, the percentages, you're really comparing to last year. When we see true economic recovery and true economic growth, will, as has happened, not always, but often in the past, will, like a pipeline that gets filled, will all of a sudden get sludgy and will service begin to deteriorate. And even in really good times, the mid-teens, when things were growing, you saw in Canada, for example, Canadian National exceeded, and I'm not picking on them, they've been a terrific railroad, but they were a classic example of they expected growth out of Prince Rupert to be high single digit and grew double digit. And they have a single line out there, and all of a sudden they got sort of overwhelmed by the volume growth. And that took several years to clean up. And at the time, we thought this is sort of a rich person's problem, too much growth.
Yeah.
It's like being too sexy. And CN thought of itself as too sexy, but what it really did was lessen shippers' confidence in railroads. And I'm not, again, let's go back to the industry, not just Canadian National. Um, their ability to handle the upside is important. And in late 22, Norfolk Southern, now subject to this merger story, began a series what would end up being 5 investor conferences across the Class One railroad system, BNSF being accepted, having one investor, in which all of them talked about pivoting to growth. To quote Keith Creel, all of them talked about the need for to manage long-term assets through a cycle, to not try to match exactly your capacity with your anticipated demand, because you never get that right. Shippers don't know exactly what they're going to be. Their crystal balls are murkier than railroads. And so the problem is when all of a sudden that demand lurches upwards, it's very hard. Railroads can, over time, add sidings, add technology, add cars and locomotives, train people, but they can't do it in a quarter or two. And you see these periods of service instability in good times. Railroads are trying to manage around that by thinking longer term. we haven't had that tested yet. Jim Venna at the Union Pacific, who is the Rail Trends Innovator of the Year for this November's conference, had talked about buffer. And what essentially that means is not trying to get the last penny out of the cost structure in a downturn in order that'll punish you in the upturn when you then are short of labor. When railroads use their biggest, most effective tool is furloughing employees, and it worked so effectively in past recessions, most notably the great financial recession of 2008-9. Uh,
Hmm.
in the pandemic, it worked in the downturn because rails once again proved their cost structure is more flexible than people had really. It's not as rigid as people thought. However, instead of three-quarters of those workers coming back when they called for them to return, when people were buying and then returning their pelotons, and you needed transportation services, only about a third or less came back, and so you had those rolling labor shortages of 2021 and 2022 that really hurt rail earnings and hurt them in the eyes of regulators and politicians. And I think it damaged rail reputation. And one of the reasons why they haven't recovered all that share right now. So what I'm getting to is that's the test. The test really is when volumes come back and are strong. From a rail perspective, you hope they're universally strong rather than one specific place, and
Yeah.
you hope that railroads have enough buffer out there that they don't really lean hard on the, on furloughs. Railroads have talked a game about this. They never used to talk about this before. So they're trying to be measured not by operating ratio. In all five of those investor conferences that went from the end of 22 to the end of 24, OR was mentioned in 1 out of 500 pages of slides. So what they're trying to say is measure us differently, measure us on our ability to handle the upside. They have not been tested, and now we have two major events that have distracted us from what would have been, what hoped a coming test. Those events being the trade war issue, which would have been the story of the year, and in the world maybe is the story of the year, but has been
Hmm.
superseded by the merger issue. So it's a long-winded way of saying railroads are talking about managing the upside better than they have in the past, not having a rich person's problem, but in fact having no problem at all. So the chippers feel the confidence that they can trust them, when volumes get bigger, and they don't need to, in an emergency, turn to trucks when trucks are short and have very high logistics bills. That's the story of the past. We haven't had that tested. Growing 2.2% now is sort of a false flag. And I would say railroads are talking a good game. I need to see a base year. I think the capital expenditures, the applications of technology that have been all of a sudden opened up by maybe the one solidly positive thing about this administration from a railroad perspective is that the FRA is approving tests of all sorts of new technologies, such as automatic track and automatic car inspection, which actually frees up a lot of capacity, not to mention catches errors that can hurt service like derailments much more accurately. So the railroads are better prepared for an upturn than they ever have been. Having had labor shortages, they've gone through the long and laborious and painful hiring and training process. So they're ready for it, I believe. But, and then we'll know if they pass the test. But they haven't had the test yet.
Okay, well said. So let's get to the merger, the proposed merger that is between Norfolk Southern and Union Pacific. It's obviously the story within the industry.
Yes.
There's been a lot of momentum in recent weeks. You had just mentioned Jim Vina, and he had met with President Trump. Trump had said in a Reuters report, "The deal sounds good to me." There obviously has been pushback from various shipper groups, and those groups come to mind for me are the American Chemistry Council, the Knit League, um, a few others too. And just lastly, the largest railroad union, Smart TD, 100,000 members strong, I believe, through its support behind the proposed deal. Lot of moving parts there, a lot of stakeholders weighing in. What do you make of things now? And where do we go from here?
All right. There's a lot here.
Yeah.
Um, I am different from a lot of Wall Street analysts who I am saying we don't have enough information. This deal can clearly get done. The question is at what cost? What do you give in remedies and concessions? Union Pacific has said it's about $750 million out of their anticipated, almost 3 billion in benefits. That's a big chunk, but that still leaves a couple million plus in benefits, and that's a 3-year look, right there. They would be building a forever railroad that theoretically, by eliminating interline issues, would free up capacity, increase speed, and greatly increase reliability, the most important thing, and thereby lead to market share gains down the road. The question is, what do you pay to get to these benefits? The benefits also include, reduced SG&A. You don't need 2 treasury departments or 2 heads of grain, and also an access to the watershed business, which is short haul business on either side of an interchange point off in the Mississippi River, where railroads would be reluctant under their cost structure to go after the short haul business. But if they own both sides of it, it becomes medium haul and therefore may be attractive. Um, where I'm getting with this is this railroad merger, having thought that the CPKC was the last merger, will be the first one under the new rules. And the new rules, which have 4 major boxes to check. The first is has to be in the public interest. When discussing taking trucks off the highway, for example, that is clear public interest. It is become axiomatic that, and with apologies to my trucker friends, that taking trucks off the highway is tax saving, is safer, is cheaper, as is has less emissions. Lots of public benefits. So they'll push that. The second box is it has to not maintain competition, as historically was the case, where if you had two railroads coming into a site, you had to maintain that second railroad. If those 2 roads are merging, you had to offer somebody else trackage rights or some way to access that to maintain 2 for 1. This merger needs to enhance service. We don't
Okay.
know what that means. That's never been defined all on purpose, because by leaving it undefined, you have left it the you know the more the uncertainty is itself an issue, just as uncertainty in trade policy is itself an issue. But so that does not that box is not checked by increasing your intermodal business and taking trucks off the highway, because that is a rail competition they're talking about. The STB does not regulate the highway or the waterways. It regulates railroads. So it's talking about railroad competition. The intermodal business between UP and BNSF counts, but taking trucks off the highway does not take that box under
Hmm.
STB precedent unless they change it. The third box they need to check is, can these benefits only be accomplished through merger and not through partnership? And here we'll see tremendous backflips from Union Pacific, which created the Falcon partnership as a response to CPKC, which is a partnership with intermodal linking CN, UP, and Ferromex. And they have been saying heretofore that that service is as good or maybe even faster than the single line MMX service by CPKC, that they can do this. Now, we know that partnerships are more complicated, right? In that service, as an example, we have 3 boards of directors, 3 different people who need to decide if capacity needs to be increased. As an example, speed to market has to be hurt. But the question is, if you can accomplish, I'm going to make this number up, 80 or 90% of the value in terms of being a little bit slower, a little bit more handoff issues, which means service can suffer a little more. If you're 90% on time, that's pretty good. And I'm 90% on time. When you hand off to me, the product becomes 81% on time, right? If you can
Right.
have these issues here, if you get close, does that tick that box? Does the SCB say, yeah, it's not good enough as single line? Or do they say, because you can get to 85% of the value without merger risk, that's what I'm talking about? BNSF and CSX have announced, their intermodal partnership. That clearly were working on this before the merger story came out, but they, gussied this up as a way of saying you can do this without a merger. CN has pointed to that very same Falcon partnership as a prime example of accomplishments without a merger. So that's the third box. The fourth box is, what are the follow-on effects? And the follow-on effects are hard to judge here, because BN is taking what I think is the second mover advantage, and that is to wait. They're not merging with CSX right now. So when the SCB considers this, do they assume a merger? What are the follow-on effects of allowing one? And that includes the idea that these other railroads who are in so far gentle opposition, although I'd say Keith Creel is less than gentle in his discussion. BNSF has put out papers saying you're not merging, et
Yeah.
cetera. What I'm getting at is if they all try to get things, the options for all the stakeholders, that includes communities, that includes labor, and they did sign a deal, not sign an agreement with their, not NS's, their brakemen, but that includes shippers, the most important constituency here, and other railroads. As they all are considering this, they've all anteed up with a kind of slightly negative press release, and then they're waiting for the application. That's a critical date, and then the response 30 days later from the STB to the application. And then you move and you decide, do you oppose, do you support, or do you extort? And by extorting, I mean ask for concessions. And those concessions can be, death by a thousand cuts. It could be trees planted in a community to offset the noise of additional traffic, or it could be as much as a structural change like open access. But keep in mind, the other railroads don't have to give anything up but legal fees. Like if CP gets access in Houston, which they have publicly mentioned, they do not need to offer up anything on their system in response. They're not merging. So you have, a really interesting situation. I am trying to say here to be a voice of reason because everybody universally thinks this will happen. And frankly, if Venna wants to have it happen, it can happen. But the question is, does he want to do it by paying more than the benefits, right? And so
Yeah.
I'm not, if this merger goes through without significant cost cuts, it is going to be really good for the shareholders of those two companies. It'll be ultimately good for the rail system, and you'll see BN and CN combined very shortly thereafter, not needing to worry whatsoever about who's president. And keep in mind that all of the major mergers that we've seen have been under Democratic administrations. So you'll see that. And I think when this administration ends and we stop the silliness of 51st state, you'll see the Canadians get involved. So if this
Okay.
merger is passed without significant changes, if then you'll see two railroads. Since everybody's aware of that but can't really talk about it, the question is, what are those costs? The other thing I want to say is that people are, I think, are getting wrong here, given that picture in the White House. As one CEO told me, we've all been to the Oval Office. Only one railroad has seen to publicize that. So the question here is the administration supporting it, and does that matter? To the issue of what are they supporting it, I'll say that the administration has changed their mind a lot, right?
Okay.
And they didn't actually outright say this. And in the two public benefit, mentions, they didn't mention Jim Vena's name. They seemed to, in the first one, it really was an excuse to talk about why they wanted to send, armed troops into the streets of Memphis.
Mm.
Um, so, will they? Does it make sense for the administration to support or oppose this merger? Rail regulation, this is a central fact that must be understood, is different than any other regulation that I know of. It is certainly different than labor regulation, environmental regulation, safety regulation, food regulation. There is no partisan position. This is a arbitration in effect of power, of market power between an enormous industry, the rail industry, and an even more enormous set of industries, petrochemicals, steel, autos, agribusiness, global retail, you name it. And the question is, why get involved in there's no Bernie Sanders' position on Dow Chemical versus Union Pacific, right? There's no partisan issue here. This is business. And so why would you want to put your thumb on the scale if you were the White House, if the other industries are in opposition, as they're indicating they might be? And I'm saying if and might. They might, in negotiations, get enough in the extortion round, and I'm joking about that, but to satisfy their claims and ultimately support it. But right now, why would you want to support this? Some people said to me, this is a legacy issue for the president. And I would say to them, and as I did, who was the president when the last spike was hammered to the ground that linked the East and the West for the first time in 1869 in Promontory Point, Utah? Some people have gotten it right, and I would say it's on the $50 bill, a bill I've probably never seen, and that's Grant. Grant is
Yes.
not known as the president who was, who got the Transcontinental Railroad built. It literally was not a single rail company, but the first time we could go from New York to California. He's known for winning the Civil War, right? He's not known for that. So I don't think the administration really should or does ultimately have a position here. If they do, and they have defied my sense of logic before, they have certainly taken on the auto industry inadvertently by supporting steel and aluminum tariffs, et cetera, and by hurting, imported car parts and whatnot. And that's just an aside. One of the beneficiaries will be global business because intermodal will move smoothly through these gateways, and that includes foreign goods, auto parts, other industrial products, retail goods that is not supportive of the reshoring movement. And if you believe this is to support a reshoring movement of U.S. goods, the rail system as it exists today under great service does not hurt reshoring, right? The service levels get better and get worse, and hopefully are on a continued uptrend. But rail service, railroads are not inhibiting plant decisions to reshore production in the U.S. Labor costs and availability, robotic costs and availability, land use, worker availability. These are the issues. Nobody is saying I'm not bringing production back from China because railroads stink. So the idea that making railroads more efficient is going to drive that there doesn't make sense to me. And ultimately, I also want to say this: if regulation is completely different, and so these are business decisions, the STB is an independent body. Now, the White House has gotten involved in independent bodies, and they fired a member of the independent body. Washington folks don't believe that Primus's firing was related to the merger, even though he clearly likely would have voted no, since he voted no for CP Casey under the much
Hmm.
more lenient old rules. I think that they were, that you can trust them on this rare occasion when they say he didn't fit the president's agenda, and he was an outspoken person about that. And I think that that's really what happened there. But
Sure.
nonetheless, this SCB is independent. They will look at this not from a party point of view, but from a rational point of view. The president's picture with Jim Venna actually puts several people's nose out of joint. I would think other railroads, other the shipper community, and even the STB, because the STB could very well come down and say this is the best thing since sliced bread. But now it's going to look like the president told them to say this,
Uh-huh.
rather than
Uh-huh.
Patrick Fuchs and his considerable power uh, and 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 brain power, and his teammates are going to look at this once in a lifetime opportunity to reshape a 200-year-old industry, and they're going to try to get all the data and make a really good decision, and it ultimately could look like they just did what the president said on a whim. I don't believe. I believe that this is going to be an independent decision. Because of that, I don't know which way it'll go. We don't really. We're having a. This was meant to be a quiet period. There's like flashes of lightning all the time now, right? Between all
Yeah.
these railroads, and anytime there's an opportunity with a microphone, you can trust Jim Venna as well as Keith Creel to be willing to get up and say what they think, and it makes for great copy. The real news will come with the application, and 30 days later with the idea of will the STB accept it, reject it, or most likely send it back for clarification. And you have to wonder, will the application try to be as plain vanilla as possible? After all, everything you put in there becomes a negotiating point, not just with the STB, but with all those stakeholders, right? Or so if you make it as bland as possible, there's less to directly challenge. Or
Hmm.
will he really go for it and make it as direct as possible, which he has basically said he's going to do? He has said no concessions. This isn't socialism. He's already also said that there'll be $750 million worth of concessions out of this, knocking out of the 3 year benefits. He can't know what the concessions are going to be yet because the application starts that, we're in that phony war period, to go back to World War II history, of between 39 and early 1940, when there were a couple of bombing raids, and there was a lot of nasty newspaper ink. But it waited until the invasion of France on March 10th, 1940. The application and its acceptance with conditions or whatever happens 30 days later, that's the invasion of France. That's when
Okay.
the blitzkrieg starts.
Understood. Tony, as a quick aside, do you have a sense on the timing of the application? Has that been, is that
So it pretty much said, because of the start of when they did the initial purchase, agreement with NS, which is an SEC issue, they had till January 29th, I believe.
okay? Okay.
Jim Venna has said publicly on more than one occasion he wants to get that done sooner, because the sooner you start, the sooner you start the clock, and among other things, Jim Venna is 66, I believe. He's
Okay.
in fantastic condition, but he wants to get at it.
Yeah.
And Yeah, so I would believe that's going to come sometime in the fourth quarter,
Okay.
maybe around the time he accepts his Innovator of the Year award at Rail Trends on November 20th.
All right, there you go. And well, that was a great overview, Tony. And just to close things out, we're a couple days away from the beginning of Q4, and I'm just wondering sort of what your Q4 outlook would be, in terms of what may be in store, what are the key things coming up? Obviously, the merger is the big ticket issue, but key things for rail and intermodal shippers to really monitor, focus on as we work through the fourth quarter?
That's a really tough question because people's focuses will be elsewhere. One of the worries that a lot of people had about this merger, not the ultimate thing, is that you are going to get the smart people, the deal makers, the strategists are all going to be in the war rooms, not out there making deals. And there seemed to be a flurry of really productive, even despite the fact the economy wasn't, volumes weren't showing much of deals, including Union Pacific opening some new intermodal positions, opening first and last mile operations with short line carriers in Eugene, Oregon, and in Kansas City. That's a really innovative thing, keeping up doing what CN and Watco have done in Louisiana. And I think that's why I really think we were maybe on the verge, and I still really think so, maybe delayed by the merger of a third golden age for short lines. There were a
Okay.
lot of industrial developments. So the railroads underneath the surface were doing a lot of very constructive and innovative things. Um, and the wonder is, will all that momentum stop for the period it takes to decide this story? In terms of the fourth quarter, it's going to be a lot like the third quarter, which is going to be a lot like the second quarter. You're going to see, modest economic growth reflected in, modest volumes, maybe slightly beating GDP on the carload because coal volumes will look, in terms of, percentage growth, coal volumes will be flattered by the comparisons. Canadians continuing to show easier comparisons. International intermodal should turn into the red, and that's a comparison issue, but also a sign that we have, sort of tepid consumer growth, no real peak season to speak of.
Yeah.
I don't know when that's going to change. We have talked about being on the bottom of the freight recession, which is really the truck capacity issue, for a year and a half. This is the longest freight recession I've ever dealt with. It started in the fourth quarter of 22. There
Exactly.
are signs that private fleets are beginning to shrink, and that's the critical element. So maybe it's under normal conditions, absent mergers, absent other stuff, we might see, truck capacity return to a balance, which will allow for both rail volume growth and rail pricing growth in that area. That would be a big positive. All the signs are there, but we have so many things going on. We're still, if the merger is the biggest story, the trade war is the second biggest. Railroads don't believe the AAR numbers that say railroads are only 39% impacted by trade. First of all, only 39% is kind of hysterical, right? That's a pretty big percent. Second of all, that only counts the U.S. railroads, and that's a mistake by the STB, by the AAR, because shippers look at Canadian railroads and Mexican railroads, and certainly investors do. So if the North American rail market is, that doesn't include transloaded boxes at LA. It doesn't include fertilizer that goes into the corn that is then shipped down to Mexico. The trade is 50% plus. So we've been roiling around that. We've created, we've crushed export grain demand through these trade wars and created a formidable permanent competitor that's going to win in Brazil for corn and soybeans. So we have lots of issues here that would be on the focus list here. Resolution of USMCA is huge. Lots of goods are exempted from these tariffs because they're USMCA compliant, but so is steel and aluminum, and he put tariffs on those. What he's doing to the auto cycle is enormous. And I'm not trying to pick on the White House. It's just trying to figure out what is the road forward. Railroads do very well even with great cataclysmic changes. If you think about the change of this country from a manufacturing country to a services based company and globalization, railroads with double stack containers managed to play. That move is not necessarily a move of weakness. After all, you should do what you do best. Most economists view that trade deficits are not a problem; they're a sign, in fact, of of economic progress. Right? We don't want to make iPhones here, right? That's pretty low wage work. We want to use
Mhm.
iPhones here. We want to design iPhones here. But the question here is, what is the future? The fourth quarter is going to be just like the third quarter. The questions are going to be driven towards, one, what is going on with the merger? The application should probably be out. And two, what are the latest uncertainty factors in trade that impacts half of the rail volume? How do we interpret that?
Okay.
Maybe things will change after the midterm, but we're in a very odd position. In the last quarterly earnings, you had the Canadians finally, fess up to the fact that tariffs were hurting them. You had Norfolk Southern not report at all. Their earnings call was entirely a merger call. They put out slides. They didn't even put them on a screen. You know, you wonder whether people are going to be making sure these roads are operating well. I would expect good operating, really good service in the fourth quarter, and really good operating performance, especially by those railroads that had been sort of out of whack a little bit, and that is Norfolk Southern, and we know about that. Having survived their proxy fight, BNSF. Both those railroads are returning to a normal, solid operating plan under their operating leadership. And I really want to single out CSX. Today, they opened up, as you pointed out to me earlier today, the Howard Street Tunnel ahead of
Yep.
schedule. They told us in November at their investor conference that this was going to be a difficult year, and that they gave a 3-year plan that was going to be back year weighted because they were going to, be doing a lot of major construction that was going to disrupt their service. And then on top of that, their rerouting areas were flooded. But they did this without any STB complaints about service, without any, customers didn't really see this. They took it on the chin themselves from a cost perspective. Howard Street Tunnel is now open. They can begin double stacking in the second quarter next year. So they are returning. Everybody's operations in the fourth quarter will be pretty good. And everybody's service levels in terms of velocity, dwell, et cetera, will be better than pretty good. And that's the thing we can look at when we look to the future and try to extrapolate. The volumes are going to be what they're going to be.
Yeah, no, absolutely well put. Well, Tony, this brings us to the end of our allotted time for the podcast. So, on behalf of Logistics Management Magazine and the Peerless Media Supply Chain Group, I'd just like to say thanks for spending some time with us again.
Jeff, I always like to spend time with you, and thanks to Logistics Management for allowing us to do it.
Absolutely. And good luck to the Dodgers. It's going to be October before you know it, and it looks to be another great playoff setup coming our
It,
way. So
it's gonna be great, but our bullpen they're all arsonists. They like to like to set fires. So
yeah. Oh boy. Well, we'll just have to see how it goes. Thanks everybody, and have a good day, and we'll catch up with you soon.
bye.
All right. Thank you, Tony.